What's up, everyone? It's Karthik with MoneyVest. Welcome on board for our market open live stream for this week. A very, very happy Monday, everyone. I am back in Dubai, back at my home office. It was a very nice and short trip to India, visiting my family, surprising them for my nephew's, Annaprashan. That's what it's called. And it was the first time he was actually eating solid food. So absolutely loved it. It was a nice little break, although I was exhausted when I got there because I took the red eye, which was a flight at like 2 in the morning, arrived at like 8 in the morning. So I didn't really get a lot of sleep on the plane, but nonetheless, it was amazing. Markets are up pre-market. We'll find out very soon in about an hour when the markets open, whether this is, a dead cat bounce, a little bit of a technical rebound, or if there's any strength to this market rebound here after a very brutal sell-off last week. Over $2.2 trillion in market value erased, which we have discussed in our previous updates as well. If the audio and the video is working well, just give me a thumbs up. Just want to make sure that there are no technical difficulties, and we should be all set for yet another week. And I got my Nvidia shares assigned to me, so it's a fresh start. I've got Nvidia 600 shares. I will be looking at selling calls, sometime today. Given that there is some strength in the stock price pre-market. So Nvidia is up a little bit over 1% right now, just under $104. So if there is more momentum, if it gets up to 105, 106, that would be ideal because then the premiums are going to be very, very high for close to the money calls, right? So the ideal price that I would like to sell the calls at are going to be 109 or 110, possibly up to 111. But I'm going to have to really take a look at what the premiums look like expiring in about 4 or 5 days. So this Friday for Nvidia, and we'll be looking to sell more puts with the remainder of the cash because that is still uninvested. So again, I'll update everybody in the Discord, and of course the options portfolio, I will update everybody on another video for members only as well. So thank you so much for joining. Hope you all are doing great. How was your weekend? Talk to me. Tell me a little bit more about what it is that you guys did over the weekend. We've got lots to cover. Bank of America coming out with a report. Don't touch tech stocks right now. Valuations are stretched, as well as inflation numbers coming out in 2 days. Palantir popping higher, up over 8% right now after the S&P 500 inclusion. Did a video on that as well over the weekend. So got lots to unpack, lots to discuss. We've also got a poll going on right now. What is everybody expecting from the markets today? More than 1% higher, or more than 1% lower, or somewhere in between 0 and 1% gain, or 0 to 1% loss for the day. So definitely do participate. Right now, we've got a little bit of a bullish stance from everybody. We got about 65% of people that have voted expecting the markets to be green, anywhere between 0% to as much as over 1%. So, green to very green. And about 23% of investors currently are calling the bluff on this rebound pre-market and expecting for the markets to continue that selling pressure that began in the first week of September. Essentially the second time it began, because we obviously did go through a little bit of a correction in August that quickly got picked up by investors. And of course, we're starting to see that rotation back lower. Okay, so morning everyone. Thank you so much for joining. I stopped eating solid food since the market crashed, saving the money to buy the dip instead. That's a good one. Amazon is undervalued. What are your thoughts about this thesis? So I love Amazon. I think it is one of the more undervalued names among Magnificent Seven companies. I wouldn't necessarily call this sort of undervalued, but I feel like there's more potential to Amazon's bottom line and earnings over the long term compared to any other stock. Maybe Nvidia comes close, and Tesla's kind of like one of those companies that can hit or miss big time when it comes to artificial intelligence and everything that they're doing with FSD, because that can be a very, very high margin business for the company. But Amazon, I feel like there's a lot of untapped potential because, in my opinion, I think Amazon spent a lot of time the first 10, maybe 12, 15 years kind of building out their logistics network. And now, they can pretty much deliver products at speed and at a scale that is just not comparable to any other company out there or e-commerce platform. So Amazon, now they've got the size and scale and the speed to operate at such, significant levels. And now they can really just focus on other parts of the business, whether it's AWS or advertising. And now the focus can really be on the bottom line and profitability. And that's really what Wall Street's been waiting for. That's what they really look for when it comes to investing in companies long term. And so I think, in my opinion, Amazon could easily get us to a 15-20% compounded annual growth rate for bottom line earnings, which will eventually be reflected in the stock price as well. So I do like Amazon. Now, there's going to be different levels that we may agree on, whether, Amazon at 170 is fairly priced or undervalued, overvalued. I'll let you decide. But for me personally, I think 150s down to 140s seems like a good area to dollar cost average into this stock for the long term. I've also got that on the 37 stocks and ETF spreadsheet as part of our shopping list, right? So again, I do like Amazon. Lower the better. As prices come down, the risk comes down with it. Okay, just keep scrolling. Says excited but expecting a downfall after the Fed rate cut. So there is a lot of expectations for the Federal Reserve to cut interest rates. Of course, pretty much it's a done deal. If you come over to the Fed Watch tool right now, you will notice that the markets are pretty much a 75% probability that we're going to see a 25 basis point cut. Actually, 77% probability now that we're going to see the rate cut in about 9 days. 9 days is when the next Fed meeting takes place. So it's going to be on September 18th. So September 18th, mark your calendars. We've got the inflation on the 11th. And then 18th is when the Fed meeting is, so next week. And 77% probability for a 25 basis point cut. And then a 23% probability for a 50 basis point cut. So in other words, we're pretty much getting a cut. It's just a question of, this came out today that they are expecting a 50 basis point cut. And that should not raise any alarm. So this was from a research firm that essentially readjusted the probability of a U.S. recession to relatively contained. And they went from 30% down to 25%. In other words, a mild recession. And they said, we are not particularly concerned that we're heading into a U.S. recession. This was Forvis Mazars, chief economist. I don't see the urgency for the 50 basis point cut. The perspectives, of course, are different from different analysts. The 50 basis point cut might send the wrong message to markets and the economy. It might send a message of urgency, and that could be a self-fulfilling prophecy, and something that we have discussed in our previous updates. And this right here was from another analyst, Michael Yoshikami, CEO of Destination Wealth Management, saying that I would not be surprised if they jumped all the way. Is my voice really breaking right now? Can you guys hear me? If my voice okay? Is there any sort of... Oh man, is this mic dying on me right now? How about now? Is it better? Check, check. 1, 2. 1, 2, 3, 4. Check, check. Mic test, mic test. Can you guys hear me? Just give me a thumbs up if you guys can hear me right now. Voice is distorted, cutting in and out. No, your voice is fine. Okay. Not only do we have mixed messages on the markets and the rate cuts, we've also got mixed messages on my microphone. It's fine. All good here. It isn't bad. Sounds fine. It's all good. I hear just fine. Okay. Now, some people are saying the audio is gone. Okay. Okay, sounds good. I'm seeing a lot of thumbs up. Cannot hear. Are you guys making... All good, all good. We hear you fine. Okay. Thumbs up, thumbs up. Audio's been consistently good on my end. Okay, perfect. I mean, if it's... Okay, I see a lot of thumbs up, so it should be fine. Should be fine. For the people that are kind of having an issue, maybe just see if you can turn down your volume and then turn it back up again. See if that works, or, refresh the stream. Maybe that works. So... Could be like a issue with connection or something, but as long as it's working and most people are able to hear it, so we can go back. Okay, so, another analyst kind of talking about, I would not be surprised if they jumped all the way to 50 basis points, for rate cuts, and that would be considered, on one hand, a very positive sign the Fed is doing what is needed to support jobs growth, and I think that the Fed, at this point, is ready to get out ahead of this. Now, I think there is going to be some debate on what is appropriate from the Federal Reserve, whether they want to do a fast cycle or when we are already in a recession, right? So most of the time, when you'll notice the Federal Reserve cuts interest rates very fast, down to near 0%, when we're already in a recession. So they want to combat a recessionary environment and higher levels of unemployment by cutting interest rates down to 0% so that they can actually stimulate that growth once again. So that's one of the ways they actually fight inflation, right? Fight recession, excuse me. The way they fight inflation, of course, is by raising interest rates, and they would cut interest rates slowly if they do not anticipate a recession or we're not in a recession, and they're simply just trying to get back to normalized policy rate, because right now we're in a very restrictive policy stance, meaning 5.25%, 5.5% is a very restrictive policy stance, and that is squeezing a lot of businesses and a lot of households out of money, because as interest rates are higher, cost of borrowing is higher, interest on debt is higher, and so liquidity is really, really low. As they start to cut interest rates, as we already know, that's going to create some quantitative easing, right? So from a monetary policy standpoint, that's going to free up a little bit of that credit in the economy. It's going to start circulating credit back into the market as people can borrow, once again, at a little bit lower interest rates, and they're going to start spending, investing. That's going to stimulate that growth. Now, the question then becomes are we going to see a faster cut or a slower cut? Because as we know that market's pretty much priced in for a cut, we just don't know how much they're going to be cutting, right? So whether it's 25 or 50. Now, in my opinion, I think it's good to start with 25 basis points, because right now, from an economic standpoint, yes, there are few indicators. One can argue that they are trending in the wrong direction. There's things that are suggesting for economic contractions and weakness, like the ISM manufacturing index, the uninversion of the yield curve, the delinquency rates, the credit card debt. I mean, you can make a lot of cases for why the economy is trending in that wrong sort of direction, and why the Federal Reserve, if they need to be ahead of it, if they need to come out on top of this, should already be cutting interest rates very aggressively by 50, 75, 100 basis points. But I do strongly believe that I think if they do that, the market's going to receive a very wrong message. Because right now, the market's also not sure whether we're going to get into a recession or whether we're already in a recession or not. But if they start cutting, if the Federal Reserve starts cutting interest rates very, very quickly, right? So if they become very aggressive by 50 or 75 or 100 basis points, the market's going to start asking a very simple question. What is it that the Federal Reserve knows that we don't, right? What is the Federal Reserve, what do they know that we don't? What are they looking at to be cutting interest rates so fast? So by default, I think the market's reaction is going to be not that great. I think they're going to start anticipating, the market's going to start anticipating, okay, the Federal Reserve start trying to front run this recession by cutting interest rates faster. That means we're already in one or we're very close to one. So that's going to create an uncertainty and the market's going to drop. So markets hate uncertainty. Markets just do not like surprises in either direction, I would say, right? Good or bad surprises. Good surprises sometimes can act as very good bullish catalysts, but in general, market doesn't like uncertainty of any kind. If there's any type of, lack of visibility for the near term, medium term, by default, the market's reaction is selling pressure. And, if you come take a look at the Bank of America report from today, and what did they essentially said, they basically mentioned over here, let's see. So right here, they mentioned don't buy the dip in tech stocks. That's what they said. This literally is a report from a few hours ago from 10 when it comes to buying the dip in tech stocks, warning that despite the recent sell-off, the sector remains risky. So what they're quoting is a record enterprise value to sales ratio. So, as we discussed in our previous market updates, the price to sales multiple for the S&P is very high. This was recorded by Charlie Bielio in one of the charts. I mentioned this in our previous updates. The S&P 500 is now trading at 2.9 times sales. This is about 8 days old. So I'm sure, this has come down a little bit because the markets have sold off in the first week of September, down 4%. But back on September 1st, we were obviously at a very, very high level of almost 3 times sales. And that's nearly double the historical median and approaching its peak valuation from the fourth quarter of 2021. So as we already know what happened in the fourth quarter of 2021, the markets formed a top, right? In 2022, the entire 2022, we sort of saw that deflationary market where we got a reset in valuation. S&P was down, I think, over 25% from its all-time highs. So if you come over to the entire bear market of 2022, it lasted almost a year. Was obviously pretty aggressive across the board for a lot of individual stocks. 28% sell-off on the S&P 500. Stocks like Nvidia, I think, dropped over 60% during that time. So this was the entire bear market of 2022. Nobody wants to relive that, down 68% during that time. I think Tesla was down over 70% or probably more than that So this entire time, it ended up selling off over 75%. So even companies like Apple were down, quite considerably during that time. So this was 2022 here, the entire sort of market, 32%, so a third of the valuation gone for companies like Apple. And a lot of that happens because, markets become overvalued at some point, right? So we kind of move in cycles where we go from overvalued, undervalued, overvalued, undervalued. But the overall general trend is the markets do trend upwards because earnings are growing. Earnings are going up on a per share basis. And so the markets continue to see that expansion. Very few times, especially if earnings are flat and you're seeing the markets go up, that is by default happening on the back of multiple expansion. And that's what happens here because multiples expand, right? Sales are constant over the last year, or revenues constant quarter over quarter, but we're seeing markets go up. So we're seeing a lot of expansion in multiples. So it's gone from 2 times sales to a little bit over 2.9 times sales. And I've done a video on this actually. It's a very, very interesting concept because let me see if I can pull up that spreadsheet so that you can better understand how that essentially works. Let me see if I can bring up the PE explanation. There we go. Okay, so this was the overall explanation in one of the videos, which I think is really, really important. I think you should go back if you haven't checked out this video. Definitely do watch it because it's going to give you a bit of an idea of how valuations in general work for the market. And this is in context of the price to earnings. You can apply this to price to sales as well. It's the same exact thing. So what I did here is I essentially took a very simple price to earnings multiple. So price at 15, earnings at 3. These are just example values. So the P comes down to 5, right? Because it's 15 divided by 3. You can do that with price to sales as well. Price divided by sales, and you can arrive at a price to sales multiple. Now here's how the PE multiple would change over here, as you can see. This is how the price to earnings multiple would change as the price and the earnings are changing. So if both of them are constant, price to earnings is going to remain constant, right? So nothing changes, nothing happens. If price goes up, but earnings remain where they are, price to earnings goes up. If price goes up, earnings goes down. Price to earnings goes up, but it goes up faster than the previous scenario. If price remains constant and earnings go down, also then price to earnings goes up because the denominator, which is the earnings going down, and then these 3 scenarios, price to earnings goes down when price is constant, earnings go up, so denominator is going up, price to earnings goes down, and same thing is true for these 2 scenarios. So our job, given the valuation for the market, whether it's price to sales, price to earnings, or enterprise value to sales, or whatever it is, whatever multiple you're looking at, is that multiple expansion happening on the back of the denominator growing? In other words, the sales or the earnings or the cash flows, are they actually the ones that are growing? Or is it simply happening on the basis of a expansion in multiple, meaning price going up? So multiple expansions happen when price increases faster than the growth in earnings, or prices goes up regardless what's happening with earnings. So that's when multiples go up and they become very, very, overvalued, so to speak. So what happens then, of course, is that it becomes a risk-off environment where, prices are overstretched. We're trading at valuations that we've not seen in a very long time. And what ends up happening is, of course, a bit of a pullback, correction, bear market, whatever you have, whatever the markets need to do in order to come back to a more normalized rate. So that's exactly what they are also talking about in that report, suggesting that the enterprise value to sales ratio is at a record, signaling that the valuations are still stretched even after the recent downturn. The bank emphasizes that tech stocks are cyclical, not secular. I don't think there's any sector out there that's secular that's going to keep going up forever. I think pretty much everything is going to be cyclical in some sense because, it's just really about the cycles of the market. And utilities are going to do well, or defensive stocks are going to do well in times of recession, versus tech is going to do well in times of growth, and staples are going to do well when there's significant retail spending. Like it's all going to be cyclical, and that's when tactical investing comes into play, right? You want to be, that's when you're being very, very tactical in your asset allocation. But anyway, they say that tech stocks are cyclical, not secular, meaning that they are closely tied to economic fluctuations. And this cyclical nature, coupled with upcoming changes in the S&P rules, introduces what Bank of America says a concentration risk for mega cap tech stocks, raising concerns about passive selling, which could further pressure these names. And they also mentioned something that we have talked about on the channel, something that pretty much the market's been indicating for a very long time. They mentioned that in contrast to tech, Bank of America is more positive on defensive sectors, such as utilities and real estate. So we've been talking about this for a long time as markets are repositioning into utilities and real estate and staples to become very, very defensive. And of course, they're offering more stable dividends as well as inflation protection or even recessionary proof. Utilities, dubbed as the tortoise of the market, have delivered total returns in line with the NASDAQ, which in fact, actually, they've performed better than the NASDAQ this year. And they said overall, don't buy the tech dip, is what BofA mentioned, as growth stocks face continued headwinds and defensive sectors offer more stable opportunities. So it should not come as a surprise as the markets are getting defensive. This is very normal market behavior because as I've showed you guys this chart, XLK divided by XLU, this is simply tech divided by utilities. This is what they're talking about. This is the underperformance that they are referring to when they say don't buy tech, buy utilities. Because of the underperformance. But this is, again, a very short to medium term tactical reallocation to being more defensive, away from growth. So if you got a short time horizon, if you got something where you want protection, less volatility, more stable dividends, then yes, utilities is the place to be. But if you're a long-term investor and you believe that this is just a small blip in the overall long-term trend, which is exactly what this has shown us, technology tends to outperform utilities over longer time frames. At least that's what it's done since the bull market began in 2009. Again, past performance does not mean it's going to happen forever, but it's been the growth really, in my opinion, is where technology is. Technology is where the growth is. Utilities are good from a more stable, less volatility and defensive standpoint. But in the short term, yes, we're going to see some underperformance in tech relative to utilities, but that also creates opportunity to accumulate. In my opinion, I think for longer term investors, that creates an opportunity to dollar cost average on some of the highest quality companies, highest quality names, companies that you've always wanted to own for the long term, whether it's chips, semis, technology in general. We've got the Apple event today, which we will be live streaming. So, we've got, I think, opportunities for all types of investors. It's really just, figuring out what is your time horizon, your risk tolerance, your how okay are you with the volatility of the market, right? Because there's more volatility, less volatility in different sectors. Okay, coming over to the markets. Again, we're going to keep discussing a lot of these reports and, we've got a few more things to break down. I also have this market regime indicator. It's been quoted in this Bank of America report, by the way, so I kind of skipped over that. But elsewhere, Bank of America's broader outlook highlights volatility in the short, medium, longer term, and the bank's regime indicator is said to have recently shifted from an upturn buy risk to a downturn sell signal. And then State Street has something very similar, which is a indicator that they have developed after rigorous testing, is what they mentioned, by the Investment Solutions Group, so ISG. And it kind of ranges between 0 and 100%. So it's proprietary, by the way. So, of course, they're not going to give us the recipe. So what we have here is something that looks like this, very similar to the MoneyVest index, but I'm sure that it's calculated based on different data points, different endpoints and whatnot. But this is as of the second quarter. There we go. Second quarter 2024. This is the most up-to-date reading, is what we have as of July 25th, 2024. And if you scroll down a little bit, they've kind of laid out some of the levels to focus on. So crises is going to be 100%. So if this index is at 100%, that means we're in severe fear, very, very extreme panic. That means extreme risk aversion in the market, and there's a crisis. And then, of course, somewhere between above the average, we're in high risk. Normal is going to be sort of like the mean, around the mean or the average value. And then the low risk is going to be below the average, and euphoria is going to be close to 0%. And as of the second quarter 2024, it kind of puts us at low risk aversion right now. So there's not extreme fear or panic or crises, but we've certainly moved up a little bit from euphoria in the first quarter 2024. As you notice, of course, we were in the euphoria coming into 2024, beginning of 2024, end of 2023. We were kind of like at a really low reading, and we've moved up quite considerably. And you'll notice that 2022 kind of marks over here somewhere. That's because we were, at a level where there was a bear market. S&P was down, Nasdaq was down. Individual stocks that I showed you earlier, down anywhere from 30 to as much as 70%. So there was, high risk aversion, meaning investors were not investing in risk assets at all. They were, in fact, moving away from equities over to other parts of the market, especially when interest rates were so high. They were parked in money market funds, and we still have over $6 trillion just sitting in the money market funds earning a good yield. But I think that capital is going to rotate out of money market funds eventually into other asset classes because interest rates are expected to come down. But as long as they stay above 2%, which is kind of like that inflation base. Bill, sorry to say that we cannot hear you at all. Might be our internet connection dropping out. Could be because I feel like everybody else is able to hear me. So try to refreshing that stream. Maybe it is some internet connection. But let's just come back over to some of the comments here. So I looked at Broadcom today on the MoneyVest platform. Our shares outstanding are flashing red. But I think there is an error because the platform is not accounting for the stock split. Yes, for stock split, I think it takes a little bit of time because our data provider is working on that. And as soon as they are updated, our platform is going to be updated. But I'll take a look at that as well. Okay, big money paying into the Petroleum channel. Dead cat bounce. Okay, bought Apple stock back then. My first long-term hold at 119. That's incredible. It's a very, very good average. And sold recently, though, was hard. Following my good morning, Karthik. It's a bull trap this morning. I'm accumulating UVXY for another big sell-off this week. Nothing can lift this market. So fair enough. I just be careful with UVXY with some of these leveraged volatility ETPs because they tend to decay very fast and they do need that volatility spike in order to make money off of them. So just be careful if you are trading volatility products. Isn't this times for growth for tech, Tony? So as interest rates do come down, yes, you can make a case that there is going to be more growth potential for technology as spending continues to increase, but there is that cyclicality for technology in general. So valuations do need to reset. We've talked about how valuations are very, very important. Price to earnings, price to sales, enterprise value to EBITDA, like price to cash flow, like all these multiples, keep track of where they are and where they've been trading historical to their averages. You can actually do that on our platform as well. So whatever stock it is that you want to look at, you can come over to the MoneyVest metrics and you can pretty much track the last 10 years worth of valuations for whatever stock it is that you want to look at. So price to earnings, price to sales, price to cash flow. So I just plotted all these multiples for Apple and how it's trading relative to its historical values. And you'll notice that post 2020 and post 2019, we saw a significant increase in the earnings multiple, sales multiple, and cash flow multiple for Apple. So it is not unlikely for Apple to essentially be stable, trade at those levels, or potentially even come down to reset that valuation. So you can pretty much plot a lot of these values on our platform so that you can get a better understanding of, where everything's kind of priced. And that's what we have also for the MoneyVest Index. It gives us a little bit of a better reading on the technicals and the risk positioning of the market overall. And then the S&P 500, the aggregate price to earnings and what percentile we're trading at. Okay, so let's see. But for long-term investors, wouldn't this be a good time to buy tech dip when it's weak? Yes, so Thomas, fully agree. I think that's exactly what I mentioned earlier as well. For long-term investors, it's a good time to kind of accumulate some of the best, highest quality companies that you believe long-term have the most potential, and you can buy them at a discounted price relative to where the market is, right? So if you kind of do your analysis, and again, you can use a lot of our calculators here to figure out, okay, what's the fair value for you? Because it's kind of interesting. I was having a call with one of our subscribers this weekend, and the reason why it is so important for everyone to create a story for themselves for individual stocks is because what it develops is conviction. That's what it develops, right? If, let's say, you're in our group and you find out everybody, most traders, investors are trading or buying Apple, right? And you simply just get influenced by that. And then you buy Apple. And then Apple drops 30%, right? People who have highest conviction and understand what's going on with that stock and the company and the business, and also there's market volatility, will see that as an opportunity to buy more shares and dollar cost average. But if you don't have any conviction or any understanding of the story, there's a very high likelihood that you may end up selling out of panic or fear because you can't handle a 30% drawdown. So I think it's really important for every investor at least have a story, understand the story and the numbers, and ask yourself, why am I putting my hard-earned money into this company? What is it that this company offers me? What's the actual benefit, right? What do I see for this company over the long term? Because that's what's going to help you during times of this market volatility, right? If a stock you bought drops 20% and you understand the business really well, you understand the long-term potential, that volatility is going to be there, right? I mean, 5 to 10% is straight up noise. It's just market price fluctuations on a day-to-day, weekly basis. And I did a video on this a couple of weeks ago also, right? It's not until over a 30% drop that you need to seriously start revisiting that story and start looking into it, in more sort of detail. 40%, spend more time revisiting that story. 50% down, that's kind of like a threshold where you really have to make a decision whether it's even worth holding or whether it even deserves a spot in your portfolio. PayPal is one of those stocks where I came down to like almost a 50% drop on that position. And I've been revisiting that story, and the fundamentals continue to be aligned really well. So we'll see if PayPal can recover. It's probably one of the worst losses for me, down 50%, both in percentage terms and dollar terms. But don't invest in a company that you don't understand. Don't invest in a company that you don't have personally spent time researching, understanding the story. So I think that's really, really important. And don't invest in any company that you don't have a conviction in, because that's what's going to help you during times of volatility and, of course, when the markets are selling off and coming down. Okay, coming back to the markets here very quickly, I'll go over to some of the questions here also. QQQs are up 83 basis points right now, so almost 1% higher. S&P is also up almost 70 basis points. Tesla, pre-market up over 2.6%. A very, very nice move up. And then Nvidia, last time I checked, was up 1%. Right now, just over 1% at the moment, trading just under $104 per share. Do participate in the poll because we do have a poll going on right now for markets today. Let's see if we can get up to at least 300 votes right now before market opens. Actually, we've got 30 minutes. So let's see if we can at least target up to 500 votes here for this market poll. And between 0 and 1%, down 0 and negative 1%, or down more than 1% as the selling pressure continues to accelerate from last week. Although pre-market, we're seeing some nice rebounds. Okay, so coming back here, sounds like we're going into the R word. Well, that's the big debate the markets have, right? That's the uncertainty the markets are facing right now, is whether we get a recession or not, or are we in a recession? And that's why this sort of checklist comes in handy. This was from, I forgot what his name was, the professor at Duke University. Let me see if I can pull it up over on these charts here. I believe it was this one. Let's see. But anyway, professor from Duke University kind of came up with this checklist where there's a case against hard landing. He expects there's going to be a potential for soft landing where why is there's voice breaking? Why is there's a voice issue right now? Are you guys can't hear me now? Could be like a wiring issue in my microphone, but is it really cutting in and out? Let me know in the chat. God, it's just, why is it so mixed? Audio fine for most people, and then there's some people that can't hear it. Roshan, why is there no audio for you? Audio fine, no voice issues at all good, all good. Okay. What's going on? Why is there an audio issue cutting in and out? Tony, Roshan, there's a couple of people that are having that issue now. Sandeep, Tony, Roshan, you guys, and Shashi are having some issues with the audio. I don't know why. Fine, no breaks. Okay. I mean, I guess... Okay, we're going to continue. If most people are having no problems, if most people are able to hear it, we're going to continue. If a lot of people continue to have an issue with the audio, then I'll see what I can do. Okay. So yes, this right here is the case for and against the soft landing, hard landing scenario. And I mentioned this in one of my previous updates where the soft landing, the pros or the signals related to the pros are actually turning worse, and the hard landing ones are not getting better, right? So in my opinion, I think there is a probability, I would say, and it's really, at this point, it's a coin flip. Nobody really knows. But I would put down, at least over a 50% probability for a mild recession in the US, at least in the next, let's say, 3 to 5 or 6 months, considering that there are indicators that are suggesting weakness in the economy. Unemployment tends to be a lagging indicator anyway. So we can't really base it off of, unemployment's low, so we're not in recession. because it tends to pop after we're already in one. So I think jobless claims is a very good indicator. ISM manufacturing index, manufacturing payrolls, construction payrolls, an inversion of the yield curve. I mean, those are some of the examples that kind of tend to lead recessions. They're kind of telling us already, suggesting or indicating us where we are. So the hard landing con, of course, the Fed has kept rates too high for too long. That has created a lot of uncertainty. Yield curve inversion with the SAM rule, as well as the rule related to the McKelvey PMES recession signal, which again has popped back over 0.54. And this reading, in fact, has never failed with no positives, no false positives, no false negatives for this. We've seen recession take place with the average lag time about 2 to 3 months, I think it was, for this particular report. So, and this is all it's doing is essentially taking into account the unemployment rate, the 3-month average minus the 12-month low for both the job vacancy rate and the unemployment rate. And it's kind of taking a ratio of those two numbers and where we are for that. So it's 0.54 right now as of August 2024. So again, we'll find out very soon whether we see a recession or not. But regardless of whether we see one or not, I think it's really important for everyone to be prepared. I think it's really important to operate at a liquidity framework which makes sense. So if you open up this spreadsheet, we're going to go over that together. And I really want to know from all of you, so it kind of helps other people in their personal finance journey as well. And only if you feel comfortable, it's up to you. Let us know, like, what is the liquidity framework? Where do you personally operate? Because this, again, becomes a little bit more psychological as well. There's no right or wrong way to do this. There's some right way to do this when it comes to finance. You obviously don't want to be so squeezed where you have nothing saved up for emergencies. And then you also don't want to be so saved up where you're not even investing or considering investing in the market. But since all of you are here, I'm going to assume that you are investing in the markets, of course. But those are some things to definitely, as basic principles, to understand. And then when it comes to here, somewhere between limited and robust, then it becomes more of a personal preference, right? Where you feel comfortable operating. There's no right or wrong, right? If you've got 3 months worth of savings saved up versus 24 months, that's totally fine. There's no right or wrong way to do this because it really comes down to what is reasonable for you and your family and your personal finances. So again, it's up to you. Feel free to comment in the live chat where you feel most comfortable in this liquidity framework, whether it's 3 months worth of savings and emergencies or 6 months or 12 months. You want to be covered as much as 24 months or 36 months, whether it's limited, sufficient, secure, robust, or excellent. Let us know. So it kind of helps other people also feel more motivated, where you want to be. I personally am at 12 months, so feel secure at 12 months worth of savings. Monthly expenses. These are your monthly expensive saved up in an emergency fund, which is very liquid cash. It could be a money market funds, or it could be something as like a high yield savings account where it's still generating a rate of return, but is also is saved as liquid cash. It's not prone to market volatility. So not considering margin, so that is different. We're going to cover the brokerage part separately. This is simply your savings account. So how many months worth of expenses, monthly expenses, have you saved up for emergencies, and where do you operate? 3, 6, 12, 24, or whether it's 0 or 1 month, let us know in the chat. Frank says Nvidia going to either 95, 95. 90, you mean 90 or 95, Frank? I could see that. I mean, the fair value for Nvidia is at $86 according to Professor Modron. Mine is even lower, low 80s to high 70s. So I would not be surprised if it actually ends up, selling off further. That's exactly why I'm planning to sell calls, close to the money calls, so that the premiums are really high. And then we'll be selling more puts on Nvidia, and we'll try to get the cost basis down further so I can continue to run the wheel on Nvidia. Okay, so we got 36 plus, we got 6. We've got sufficient 6 months, 6 months, 6 months. Okay, so a lot of people kind of operate in that sufficient category, which is good. That's perfect. And then, sufficient, secure, again, there's no right or wrong answer. And this is where the portfolio comes in, right? This is separate. This is your brokerage platform, total portfolio value as cash. And whether it's 5%, 10%, 20%, this number can fluctuate obviously depending on market conditions and how you view opportunities in the market. But really just this is going to be a bit more distressed. If you are taking on margin, you have no cash to invest, you're borrowing money to invest more. That's when you would be in terms of the distressed, and underinvested would be if you have more than 50% just sitting on cash, not invested. And that's also okay. Again, there's no right or wrong way to do this. It's just what makes you feel more comfortable and whatever is reasonable for you. Warren Buffett right now is sitting on hundreds of billions of dollars of cash, probably sits somewhere between 30 and 50%, right, in Berkshire Hathaway. That's kind of like opportunistic because he's ready, right? He's opportunistic. He's ready. If there's a sell-off, if there's better deals in the market, he's ready to take into account how much cash he has and then, of course, deploy all that capital into the market and take advantage of those opportunities. So there's no right or wrong answer, like I said. It's really just dependent on where you feel most comfortable and how you want to manage your money. No debt is the way to go. Only real estate is good debt. Yes, I agree. I did a video on debt as well. I think that's also very important. There's good debt. There's bad debt. You want to be very careful what type of debt you're taking on. The worst type of debt you can take on is high interest debt to buy a liability. And that's what car loans end up being. I was watching a couple of videos on YouTube where this dealership, the salesman is talking to people, and man, it's absolutely wild. It's absolutely wild. I was looking at a couple of videos and it kind of popped up on my feed where he was doing TikToks and stuff, kind of asking people about their monthly payments and stuff. And then, of course, started calling his customers. And the cars they were driving, for God's sakes, it was like a $70,000 or $80,000 cars, $90,000 cars financed at insanely high rates. And they're making like $3,000, $4,000 per month. And oh my God, like their payments were like $1,000 or $1,200, including insurance, or $1,500. They were fine paying that, 40 to 50% of their income just going to a car payment. And it was wild. It was wild. I was like, what is going on? It's crazy. So yes, definitely do avoid bad debt, high interest debt, especially when you're considering buying liabilities. It's just... Okay, Caddy, how would you characterize this pullback? When would you say things are over and we're in clear to go long? I think it depends largely on recession, Frank, to be honest. But if I were to give you and share some stats here, we've already talked about how the bear markets during recessions tend to be deeper and longer versus without a recession when they only really last for 6 to 7 months and they're down 20 to 23%. Now, we've also discussed where the markets become incredibly rare. Anything over a 20% sell-off is a clear signal for me to be, buying. So there's no specific point I could tell you that, okay, at this point, the markets are going to bottom out and they're going to be, they're going to be ready to go long. But I can tell you that at certain levels, I think the risk reward is going to be much better. It's going to be significantly better, right? It's going to be really, really favorable to go long at those levels. So S&P 500 coming back over, 5,400 is where it's at the moment. And then, of course, if we do end up down to as low as 5,100, 5,200, down almost 10% in a correction, Money Vest Index down to like 3 or sub 3, that's where I will start going long again, whether it's leveraged ETFs or other ETFs. And then we'll start aggressively dollar cost averaging as it goes further. So it's really just dialing up on that aggressiveness as prices come down. So not a specific level where I would say that, market's bottom. Largely depends on whether we get a recession or not. So I treat these pullbacks and these corrections we get down to, the better those opportunities will be for us to dollar cost average and buy. Kim says, but do you actually feel sorry for people who do this? Common sense, come on. Well, Kim, that's the thing, right? I mean, I don't know about their circumstances and I don't know, about why they did it. So I also think that personal finance is something that I really wish we were taught like in school. I went to school, 4-year university in the US, and, not a single class I took, and I was a finance major, like not a single class or course I took taught me anything about taxes or about debt, loans, or how to build a credit score, how to negotiate, how to ask for a better salary, like things like that, things like actual life skills related to money that I think are super, super helpful. It's kind of weird, isn't it? Like, isn't it like really crazy once you start thinking about it that things, how to buy a house, like that would be helpful, right? What all documents, what all paperwork to really consider, how to file taxes, like the most basic thing that everybody should know, should learn. Like it's already way too complicated, and then you tag on the lack of understanding of how to file it. These are really important things I wish everyone would learn, and it would make things so much easier. Like another really simple thing is the savings rate, right? So if you come over to the savings rate in the US, like less than 3%, and globally as well, even in India, it's like less than 3%, I think less than 5 or 6%, whatever it might be, but it is low. And so people clearly are not saving enough, and let alone investing, right? So I just wish that those were things that were taught. So yes, I mean, I do feel sorry for their situation, but they made the decisions based on what they thought was best for them at the time they made them. It's just, I guess, lack of understanding without having proper direction, I guess. So TLT is priced for the upcoming rate cuts. To this point, I think yes. So the 10-year yield, if you come over to the 10-year yield here, so Walt says this problem with personal finance example, how to read agreements, understand interest rates, understanding compounding is, I guess, everywhere in the world. They want to keep us poor. Yes, I think it's true, because as we know, credit card companies make a ton of money when it comes to just interest rates. It's ridiculous. It's ridiculous how much interest they charge you on auto loans and on credit cards and everything. Like it's crazy, right? Everything when it becomes for profit for real very quickly. But so for interest rates, I think there is more potential downside. I could see them bottoming out at 3.2%, and this is more like a 12-month forecast, not a 1 month or a 6 month forecast. I think interest rates, as the Federal Reserve continues to, slowly and steadily cut rates down, I think a 3.2, almost 3.3% is possible. That's why, TLT is a ETF that kind of benefits from those interest rate cuts. However, I mentioned this in a Discord as well, the risk reward is not that favorable anymore. Even after knowing the fact that, okay, interest rate cuts are coming, right? There's a possibility that we get 25 and then progressively 50, 75, 100 basis points over the course of the next 12 to 18 months. How much upside does TLT really have? That could be about a 5 to 6%, $100 and $405, or maybe even higher, but the risk reward is a little bit unfavorable for TLT right now. So if you're already in this, I think it's better to, in my opinion, just hold and wait for those rate cuts to play in and get TLT back up to 104, 105, possibly even in 110s. But starting a new position here, I think the risk reward is not that great at the moment. Eric says, paying taxes is easy, just don't pay any and they will come find you. Let you know what you owe. God, you guys crack me up. Okay, so coming back over to some of the comments here. Ready to get a second mortgage. TLT went over. Yes, Eric says, what's common sense to you may never have been taught to others, though. That's very true. Good morning. What's your thoughts on the market, green or red? Do poll, please. Tesla looking good. Well, I think it's possible to get a dead cat bounce here, a little bit of a technical rebound, and the reason we say that is because if you come over to the 30-minute time frame, we're at a decent support, right? So 5,400. We broke down very aggressively, as you can see here. This was the breakdown last week when we talked about the big test for the bulls. We broke down, we failed that test, and then we continue to see that selling pressure. And now this is the second test where 5,400 needs to hold up. That's this level right here. So if the markets kind of rotate back up, I mean, there's a possibility. But eventually, of course, that's a level we need to hold. If you break down below 5,400, then yes, things will get worse. In my opinion, 5,200 is a possibility. Back down to the levels from back in August. August 5th was that low when we're down almost 10% from all-time high. So that is a possibility. 5,400 on the day is a level that I'm watching currently. And QQQs, I believe also coming down to a reasonable area of support and area of demand here. So 448, 450 is going to be that level. Once again, we're kind of gapping up already. So 454. If you break out back above this level, come down to retest this support, then there's a possibility for us to retrace back up to 468. But if you get rejected here intraday, we're already gapping up. We come up, get rejected, then this is possible down to 445, once again. So the level to watch on the QQQs, 454 on the day here. So yeah, that's where we are. ELF, my thoughts. I've done a couple of videos on ELF in the past. We'll just get ready for market open here. Then we'll come over to some individual stocks again. Is it a good idea to buy puts now, seeing a sell-off as it seems there is a bounce today? Well, I've never been super keen on buying options, buying puts and calls. I know that people tend to do it. Of course, there's a lot of very successful traders, investors that have done it. You can certainly apply that strategy, but I've never been keen on sort of buying puts or buying calls for that matter. And they tend to act as a bit of an insurance premium, a bit of a hedge, where you're hedging your position, by buying puts. Markets drop, great, your puts print. If they don't, then they expire as worthless out of the money, and you of course make money on your long positions anyway. So if you're treating it as a hedge, sure, but if you're treating it as a moneymaker, then consistently, you really got to get a strategy down to figure out, okay, why is it that you're buying? What is it that you're buying? What's your risk profile? What's the stop losses? All that stuff, really, really important. So institutions mostly buy puts to hedge, because they know that probability for success is quite low, especially when you consider that you have to be right on the time, the price, and the direction all at the same time, every single time, which is very difficult to do. Especially consistently, it's not that easy. 10 more minutes. 7 more minutes now. 5,500 retest and back down maybe, so is also possible. Put call ratio is 1.15. So that's where we are, 1.153. And S&P 500, so coming back here. I'm interested to take a look at Nvidia premiums now, Nvidia call premiums. So if Nvidia call premiums are good, we're looking at some decent money for this week. Last time I checked, the 109 calls are about $1.22. So expiring this week in 4 days. That's not bad. But this is not priced for the pre-market move of Nvidia, which is up over 1%. So, the moment the market's open, they're going to get repriced. I'm looking for at least $2. If you can get $2, that's great. For 109 or 110, that would be like a pretty good trade right there. Yes, if you bust through 105, I think these premiums can jump up to like 175 to $2 per contract, and then we're doing pretty solid there. Expiring this Friday, if Nvidia gets up to 110, great. If it doesn't, even better. I get to keep my shares and collect over 1,200, 1,400 in just 4 days. So that's going to be the trade for this week. Keep you guys updated. Do you think Tesla has a resistance at 221? Let's just break down Tesla here very, very quickly. So Tesla 233 would be the level that I would be watching. I guess you could say that there's maybe another resistance that it's struggling to break out of at 225. That's a level that we've gotten rejected a couple times already. So, a little bit of rejection there, resistance, a little bit of support, broke down once again. So 225 would be that resistance for Tesla, and support right now at $208, down to as low as 190s, of course. I've got calls on Tesla. I think $300 strike, and we'll most likely be selling more. I think Tesla's really just been one of the best stocks to run the wheel on. Like literally last 3 years, if you were just running the wheel on Tesla, man, it's so much money, right? It's so much money. Last year, I remember in the summer, I kept rolling out my calls because of how aggressive that rally was. This year, I was like, I'll let them expire in the money because it's okay. Like that was good profit, and I was able to get out at 230. And then we'll sell more calls and sell more puts on Tesla. Premiums have been pretty solid for both Tesla and Nvidia. Okay, thoughts on buying deep in the money calls for far out expiration. So really that's leaps. What you're referring to is, buying deep in the money calls where you can get delta as close to 1. So for every $1 move in the stock price, your options contract is also going to move 1 to 1 with respect to the actual underlying stock. And far out expiration. So if you can go out as far as 2 years, 2.5 years in some cases, maybe even 3 years. So if you're bullish, of course, if you're long term, very optimistic about that particular stock, then it makes sense. We've got a separate leap calculator that figures out, okay, whether it's even worth buying leaps or you're better off just buying straight up stock. What leaps really does is also contains your downside, because whatever premium you end up paying, that's the max you can lose, right? So premium paid is your max loss when buying leaps. So that's your loss that's kind of contained. But at the same time, leaps, you've got to do the calculation of intrinsic and extrinsic value and also understand what percentage of the overall stock price is what you're paying. Meaning that if a stock, let's say, is trading at $100, and you're buying leaps on that stock, and you're paying, let's say, $6,000, right, to buy that leap, one contract. So that's going to be 60% of the cost of buying 100 shares in the open market, because you could buy 100 shares of that stock at $100, that's $10,000, or you could buy one leap and have the same one-to-one correlation with the underlying stock and pay 60% of that. In some cases, you'll find it's going to be equivalent to, like, for example, let's just check PLTR. Let's come over to calls. Let's go deep in the money here. Premiums are not loading up here. That happens sometimes. I mean, for VBull, it takes a little bit of time. But let's go to Nvidia 2026. Again, premiums are not there. But in most cases, it's going to be around 70, 80%, maybe even 90%. And so you have to do your calculation to see whether it makes sense to buy leaps or not. We've got a whole leap calculator that I've shared with everyone. And then also did a video on intrinsic and extrinsic value over there. Okay, Kenny says bull trap big time. We've got 422 votes right now. We got 2 more minutes left for markets to open. Let's see if we can get to at least 500 votes, and then we'll close the poll, everyone. Thank you so much for joining. We're ready for market open. We've also got the Apple event coming out later today at 9 p.m. Dubai time, which is going to be around, I think, 4 hours from 9 p.m., which is going to be 1 p.m., I guess, 1 p.m. Eastern, is when the Apple event takes place. So I'll be live to cover that as well. And we are ready for market open. Participate in the poll. We're going to close it in about 30 seconds. So if you haven't voted yet, let us know what you're expecting from the markets today. A very solid half of you, 48, 49% of investors today are expecting the markets to be above 1%. Incredible bullish sentiment. QQQs are up close to 1% here, and S&P is up over 82 basis points right before market opens. So we are ready to go, folks. Nvidia is up almost 2%. I'll take a look at those premiums here very, very soon, very quickly. I may have to cut off the live stream here very soon because I have to trade. I usually do that on my phone, but I have to really think and trade, but we'll see how it goes. So here we go. Markets are open. We're at almost $105 for Nvidia. The polls are closed. 73% of investors right now expecting for markets to be higher between 0 and over 1%. Okay, let's take a look at call premiums. They're not loading up yet, so I'll allow for a few more seconds. There we go. So 110, 109 is $1.63. 108 is almost $2. Should I take $2? I should take $2 here. Maybe I'll do 109. We'll see. So 2.4%, $105 is where we are right now for Nvidia. And let's see. There we go. Nvidia up 2% at the moment. QQQs are up 87 basis points. S&P is up 78. So nice little rebound at the moment after the markets have opened. We'll see if this continues or if there is going to be some intraday weakness and this September sell-off continues for the market here. Milan says, I'll sell mine after yours because you always get me a better deal. That is true. That is true. We've got an unspoken rule in our Discord to make the trade a few minutes after me because I tend to always time them wrong. But it's okay because I'm not like day trading anyway. So Okay, let's do 16 strikes here. Nvidia's up 2.5% up to $105. I'm just going to go ahead and... Okay. Oof, Nvidia's up 3% right now, a share right now. How much do you think Nvidia's going to be up this week? Are we expecting it to trade up to as much as 106 today? Look at that pop in Nvidia. What an incredible pop here, folks. I could move up my strike here. Could move up my strike. I think that's good. I think that's good. I'll just wait a couple more seconds here, see how it trades, because, oof, look at that rally in Nvidia right now, 3%. Call premiums are jumping, folks. Call premiums are jumping right now. $3.4. Incredible rally. It looks like it's going to test 107 right now. Okay, I'm not going to be too greedy now. Okay, just give me 1 second. I could have layered it. I could have definitely layered it out a little bit more, but that's okay. Okay, this Friday is 9/13. All right, we are good to go. We'll see what the timing looks like for this trade, but it is what it is. I like the fact that it's up 3.2% back up to $106. Yes, I mean the thing is that I would have definitely gone 108 if Nvidia was like below 104 as it was pre-market. But then as it was pushing higher, I mean, might as well just take a little bit of that capital gain on the options portfolio while I can, because the momentum's strong, right? We'll see how Nvidia ends up trading the entire week. Either way, it's a trade that I feel very confident on, because yes, Milan, I'm gonna layer that out. I should have done that. I should have layered them out a little bit, because of the fact that it was pushing higher. I could have definitely looked at 110, 111, 112. Palantir calls up next. Yes, so Palantir calls today probably also popping 10%. I think it is worth looking into that as well. Nvidia calls are already up like 6% right now, so not bad. But see, yeah, Palantir up 9%, starting to drop. I mean, I feel like just a minute ago was probably a good level to be looking at selling calls here for most companies. Like Tesla's up 3%, 217 right now. I'm most likely going to be looking at Tesla calls as well. Yes, it's hard to do it during live stream because I have to think about a lot of things. I was looking at Delta. I was looking at the price itself. Then we have to look at the resistance on Nvidia, and then let's see if we can do it on Tesla as well. But Tesla, I'm kind of down to like the number of shares which I'm not comfortable letting go. So that's why I have to like go way far out of the money. I have to go out, I'm looking at 325 or 350. And I also want to don't play into the robotaxi event, because October 10th is a robotaxi event. And you just never know. I mean, what Tesla can do around those robotaxi events, right? It can absolutely go crazy. Wouldn't be surprised if it trades back up to like over $300 by robotaxi event. It's just so that's why I think the October 4th expiration is what I really like on Tesla. But October 4th, 300 is like 50 cents, half a dollar. Why not sell calls closer to the robotaxi? So that's what I'm doing. October 4th is the strike that I'm picking. But then again, like it's going to be one of those things like you buy the rumor, sell the news type deal. Like Tesla could go up like leading into the robotaxi event. So October 4th, I mean, we could easily see Tesla much higher kind of leading into that event, where it gets up to that level. Why is the audio cutting out today? Like it's just so weird. Can't hear me for the last 2 minutes here. Not sure why. So sorry everyone, I'm just looking at premiums on my Webull, and then also like looking at what trades I can place for options for this week. Maybe this week, Tesla calls for this week. Friday, September 4th, 250, 30 cents. Not bad. I mean, that's like that's an extra $100. 235 is $1.29, but 235. Palantir is up 10% today. I mean, it was supposed to be up, quite a bit from the S&P 500 inclusion. But yeah, quite a significant move here on the day for Palantir as well. It's actually trading back up to $33 today. Very, very nice move. 235 for Tesla is about 8%. 8% is easily possible in a week for Tesla. I mean, it's gone up way more than that. 27% in 1 week. I don't want to take that risk at all. Palantir, look at that. New 52-week high coming up. Next stop, pretty much the all-time high for Palantir. Rebecca, if the audio is cutting in now, could you try and refresh the browser? It could be like an internet connection or something, because I've had people all day. Well, most everyone has been able to hear me just fine, but there's been people that have not been able to hear me with the audio cutting out. So audio driving me nuts every 2 seconds. Why is that happening? It's so weird. Open and close YouTube worked for me. So yeah, maybe try that and see if it works. But Palantir, 11% move to the upside. Absolutely incredible. Srinivas, CLH, and Zscaler. So Zscaler, trading at a very nice support. I think it's a support where it can be traded. Fundamentally, though, I think there's valuation risk there, because Zscaler historically has traded at pretty expensive valuations. We've also got a big gap that Zscaler needs to fill in here. So, we got a big gap here around the 165 to as much as 188 level. Zscaler has turned the corner towards profitability, done really well in cybersecurity. Figure out what your fair value is. I like the company long term, but valuation is certainly a bit of a risk for Zscaler. So area of demand inside that support in the 150s down to as low as $87, $80 for Zscaler. CELH is another company that we have analyzed. I think the next support I'm really watching is going to be $27. I'll set some alerts for $27. And the moment it gets down to that level, we'll come back and reevaluate this company, but really, really oversold right now, right? So definitely selling off quite aggressively at the moment. It's down, I think, 67%. So very aggressive sell-off for Celsius. Okay, so what do we have here is Nvidia up 3%, Tesla up 3%, Microsoft, Netflix, Amazon, Google, everything's up 1.5, 1.3, 1.7%. Apple, the lone survivor, really survivor in the sense that it's down over 80 basis points. So the one that's selling off today on the back of the Apple event that's going to happen in about a few hours here. So I will be live to cover that event in about 2 hours. So 2 hours I'll be live. I'll take a break, shortly to go get some dinner, coffee, whatever, and then I'll come back. And it's going to be a pretty long live stream because the Apple event, we'll discuss the markets, we'll come back, see how everything is doing, and then of course prepare for market close. So yeah, that's where we are. Pretty strong move to the upside. Let's come over to Nvidia, up 3.4, $106. I swear to God, if Nvidia is at 125 by Friday, oh, I'm just kidding. I'm fine. Since it's an options portfolio, I'm totally fine with assignment on either side because that's the whole objective, is to run the wheel. If it were like my long-term shares, which I'm not touching, then I'd be pissed. So what are your thoughts on SOUN? Looks like we could make a strong move to the upside with some gaps ready to get filled up here. Strong AI software player. So SOUN, let's take a quick look. So I'm going to take a look at this from a technical perspective. So more 1.6 billion market cap, very, very oversold, I would say, or at least coming down to those levels. And it has a very nice, interesting triangle pattern where, you could argue there is, I guess, a little bit of a higher high and higher low. And then if you sort of look at like this, there is breakout potential. But Frank, I would suggest that it needs to take out this level at 553. Then, I would put a target up to 635 for this stock. So that would be the next target. And then, of course, a very strong range of support here for this stock. So looks like massive move. I don't know how much it's shorted right now. Looks like it is pretty heavily shorted as well. Sound Hound, 550% rally here. And then right now, this is the technical breakdown. For the flunky CN2 caddy, can't wait. You better rest up. Tend to keep grinding. Yeah, it just doesn't feel like a lot of work because I love this. I love coming live, talking about the markets and discussing more and more about money and personal finance. And it's always been interesting for me. So here we are. NASDAQ, the fact that it's holding up really well is a good sign. Last week saw a lot of weakness. There were no bids, no buyers stepping in. So today we're starting to see some recovery. But I would take that with a grain of salt because if you come back to our chart here, SPX that I showed you guys, 5,400 is that support. So this right here, 5,400, very, very important level. And resistance all the way up to 55.65. So this is really the range within which S&P is kind of expected to trade. And if it breaks out above 55.65, then potentially get back up to that upper range of where we got rejected at 56.40. But then support level 5,400. That's the level the bulls need to kind of hold up on the day today. And QQQs here coming up to that resistance. So if there is any selling pressure that begins now, you better believe that that's a resistance kind of keeping us lower at 454. But it's really going to come down to whether we break out or get rejected from that level. Let's see why 454 is a level that we're watching. So in the past, it's kind of, you can see that it's been a resistance area. Over here, got rejected. A little bit of consolidation and both support resistance. Scroll over again, resistance. You can see that it's historically been a level where NASDAQ's struggled a lot. We've got support here. It's old resistance turning into a support. Another very important resistance. So you can see that we've actually kind of left gaps here in the 450s as well. Quite a few times. Doesn't seem to be a lot of trading in the 454 range for QQQs. So that is quite interesting there. And let's see if we scroll further. So scroll further here. That's where we're coming up to now, 1%. So that's a level to watch. Calendar spreads, Vault. I haven't done this strategy in options. I've kind of stuck to just selling covered calls and cash secured puts. And then there's a few other strategies that we do talk about in our option scores, like straddles, protective collars, zero cost collars, and sort of my strategies have always been a little bit more risk averse. And what I like to aim for is higher probability of success, even if that means, let's say, less in terms of return or money, right? So buying calls, of course, can be cheap and can result in a very high profit. But for me, I think it's more important is high levels of profitability, high levels of probability of success, even if that means giving up on some of that upside. So that's what I like to focus on. Milan says, wait, dude, weren't you in India with your nephew over the weekend? Yes. I took the red eye from Dubai to Kolkata on Saturday night. Saturday night meaning Sunday morning. So like at 2 a.m. Folks, don't do it. Don't do it. I think it was my first red eye. As much as I've traveled, I've never caught an overnight plane. I think ever. I'm trying to remember. I don't think I have. I think it was there's been overnight trips where I've left at like 10 p.m. from India to the US and gotten up to like landed, at like 9 or 10 in the morning. So that's happened. But this was a 2 a.m. flight, which I reached at 8 a.m. It was brutal. Especially if you're flying economy. Like it is bad. You're just, you're not able to sleep. You're not able to get any rest. So yeah, I kind of had only 2 hours of sleep all Sunday, and at the event, it was like a 6-hour event. And by the time it was done, I was like so exhausted. And then I had a morning flight back to Dubai. So just been traveling a lot. Okay, calendar spreads. A lot of individual stock questions. We'll definitely come to them. I've covered a lot of those companies in the past. Like we've looked at Micron, Thai. We've looked at LUMN. I feel like we have done some analysis on that before. Lumen Technologies. Let's see, 5.5 billion market cap. Wow, what a massive run up from July here. Dollar to as much as $7, 615%. So yeah, definitely be careful with these types of run-ups, but we've got a decent support at 445 and then a little bit of a descending triangle right there. Nvidia, down 2%. Those calls are going to be up printing right now. If they end up actually up, more than 80% this week, I will most likely be closing them out and then selling new ones on Friday. We're up 9% right now on the trade that we just took this morning. Not bad. Rack up the miles. Yes, racking up the miles on Emirates. It's a pretty solid airlines, to be honest. I got a relatively cheap upgrade this morning because I was not having it. I was like 2 hours of sleep last night. Also 4 hours of sleep. 2 hours of sleep the night of my travel, and 4 hours of sleep last night. I was like so exhausted. I was like, just upgrade me to business. I can't not sleep for another 5 hours. So I was like absolutely passed out the entire ride home. Okay, guys, we're gonna take a break. It is almost 10 a.m. Eastern in New York. We're gonna come back live in about a couple hours to cover the Apple event, and I'm gonna spend some time in our community, sending out some more alerts, especially on Tesla. I'm looking at some Tesla calls, which I will be looking at. So thank you so much for joining. Join back in a couple hours. We'll be taking a look at Apple. We'll have the live Apple price action as well as the Apple event going on in the background. So we'll listen to what Tim Cook and everybody else at Apple is going to be releasing for their new products, the new iPhone. So all that super exciting stuff coming up. Make sure that you drop a like and subscribe to the channel if you haven't already. Share these videos and live streams with your friends, family, other traders, investors that can benefit from all this. I would really appreciate that, and join in a couple hours. So happy investing. Hope you all are doing great on this Monday morning. See you guys in a little bit.